In 2024, the banking cartel is betting on your nostalgia to strip mine your future. The typical U.S. home now costs $405,400, while renting that exact same lifestyle averages just $1,901 per month. Meet Alicia and Ben. Both are 29, earning identical salaries in the same city. Ben follows the old script and buys the dream. Alicia rents the so-called waste. To the naked eye, Ben is the responsible adult. But hidden in the math is a lethal financial anomaly I call the equity illusion. While Ben is drowning in an engineered surcharge, Alicia is quietly outpacing him by 6 figures. I'm going to decode the exact algorithm extracting wealth from homeowners right now, using verified 2024 data from the Federal Reserve and S&P Global, and hand you the calculator to prove who is actually getting played. The system has a dirty secret they are desperate to keep hidden. The standard advice to stop throwing money away on rent is currently a trap designed to freeze your liquidity. For decades, we have been fed the lie that renting is burning cash, while buying is building wealth. In 2024, that logic isn't just flawed, it is financially fatal. The mechanism they use to obscure this reality is the price-to-rent ratio, a signal the banks watch closely while hoping you ignore it completely. Trading economics data from December 2024 reveals a price-to-rent ratio of 134.04. This isn't just a DRY statistic. It is a flashing red warning light. Historically, when this ratio disconnects from reality, it signals that the cost of ownership has mathematically detached from the utility of housing. The banks know this. They know that when the ratio hits these extremes, the monthly premium you pay for the title deed is wealth that is extracted from your pocket and transferred directly to their balance sheet via interest. Let's look at the victims of this extraction. Meet Alicia and Ben. Both earn $86,000 as marketing managers in a high-cost metro area. Alicia is renting a comfortable apartment for $2,400. She feels the pressure. Rent eats 37% of her gross income. It hurts. But Ben decides he's done paying a landlord. He stretches his debt-to-income ratio to the absolute limit to buy a $450,000 condo. He thinks he has secured stability. He thinks he has escaped the trap. He is wrong. By locking himself into a mortgage at 2024 rates, Ben has walked voluntarily into a financial prison. Experian Insights confirms that young professionals are already facing a 44% rent burden. But Ben's mortgage burden is significantly higher. Once you factor in high interest, property taxes, HOA fees, and maintenance, Ben isn't building equity. He is servicing debt. He has zero monthly liquidity. If his car breaks down, he is putting it on a credit card. Alicia, despite the pain of writing that rent check, has a mathematical surplus of $1,500 every single month, compared to Ben's total housing outflow. The system calls Ben a homeowner. I call him a hostage. Here is what they don't tell you about that surplus. The banking industry profits from your belief that a mortgage payment is forced savings, while rent is a total loss. They rely on you not running the numbers on what Alicia does with that extra $1,500. This brings us to the second layer of the trap, the opportunity cost. The financial industry loves to talk about home appreciation because it sounds safe. It sounds inevitable. But let's look at the scoreboard for 2024. While real estate agents were promising that home values only go up, the National Association of Realtors and FHFA data show home growth staggering at less than 3%. It barely kept pace with inflation. It was a dead asset class, masquerading as a golden goose. Now look at where the real wealth went. Y charts and S&P Global data confirm that the S&P 500 delivered a total return of 25.02% in 2024. This is the discrepancy that destroys the middle class. While Ben was high-fiving himself for his condo appreciating a meager 3%, which doesn't even cover his closing costs, the capital he tied up in his down payment and monthly overage missed out on a 25% explosion in the market. Let's go back to our story to see the damage. Alicia takes that $1,500 monthly difference, the money Ben pays to the bank in interest and taxes, and she automates it into a low-cost index fund. She ignores the volatility anxiety. She ignores the headlines. In 1 year, her portfolio grows by 25%. On her initial investments, plus monthly contributions, she is compounding wealth at a rate Ben cannot touch. Ben is paying down his principal at a glacial pace. In the early years of a mortgage, amortization schedules are engineered to pay the bank first and you last. Ben's net worth is stagnant, tied to an illiquid concrete box. Alicia's net worth is liquid, growing, and accessible. The gap between them isn't just a few $1,000s. Over a decade, it becomes a life-altering divide. Comment below if this 25% versus 3% gap changes your perspective on what a safe asset actually looks like. The system relies on a specific myth to keep you in line. Rent is unrecoverable, but a mortgage pays yourself. This is a linguistic trick. They want you to believe that every dollar sent to a mortgage is retained wealth. It is not. We need to introduce a new metric to your decision-making process: unrecoverable costs. This is the only way to compare apples to apples without getting scammed. When you rent, your unrecoverable cost is the rent. Simple. $1,901 goes out. You get a roof. The money is gone. But when you own, your unrecoverable costs are hidden in the fine print. Mortgage interest, unrecoverable. That's profit for the bank. Property taxes, unrecoverable. That's a subscription fee to the government. Maintenance, unrecoverable. That's the cost of entropy. Insurance, unrecoverable. The banks don't highlight this column on the loan estimate. Let's run a forensic audit on Marcus, a 32-year-old engineer in Austin. He compares that to his current rent of $1,900 and thinks, well, eventually I'll own the house, so the $4,200 is better. This is the calculation error that keeps people poor. We need to strip out the equity portion and look only at the burn rate. On that home, the interest payment in year 1 is roughly $2,400 a month. Property, maintenance, and insurance add another $500. Marcus's unrecoverable cost of owning is $3,500 per month. His unrecoverable cost of renting is $1,900. By renting, Marcus saves $1,600 a month in pure, unrecoverable waste. He isn't throwing money away on rent. He is saving money on interest, taxes, and repairs. The bank is betting Marcus won't do this math. They are betting he will look at the total payment and confuse principal with cost. Of course, the system has a counter argument. They threaten you with rent inflation. Your rent will go up, they scream. And they are right. NerdWallet and BLS data show rent inflation hovering around 2.9%. It is a real risk. But compare that 2.9% rise on a $1,900 rent check against the fixed, front-loaded interest of a mortgage that is double the cost. The math takes decades to break even. In the meantime, the renter who invests the difference has built a fortress of capital that makes them immune to rent hikes. So how do you navigate this minefield without stepping on a trigger? You need a rubric that ignores the cultural pressure and focuses entirely on the math. I've developed a 3-step decision framework to bypass the emotion. First, calculate your local price-to-rent ratio. Take the median home price in your specific zip code and divide it by the annual rent for a comparable property. If that number is over 20, the market is signaling a bubble. You are paying a massive premium for the privilege of ownership. Right now, in many major metros, we are seeing ratios north of 25 or 30. That is not an investment. That is a donation to the lending industry. Second, calculate your specific unrecoverable stack. Do not look at the mortgage payment. Look at interest plus taxes plus insurance plus maintenance. If that number is higher than your potential rent, you are strictly better off renting from a cash flow perspective. Be honest about maintenance. Budget 1% of the home's value per year. The roof will leak. The water heater will die. The system does not warn you about these capital expenditures because they want the sale to close. Third, and most importantly, run the Invest the Difference simulation. If you rent, you must invest the savings. If you spend the difference on lifestyle, you lose. But if you take that gap, the money Ben is paying in interest, and put it into a diversified portfolio, you harness the engine of global capitalism rather than the stagnation of local real estate. This is how you opt out of the rigged game. Consider Carlos, a teacher in Phoenix. He felt the cultural shame of renting at 34. His union peers pushed homeownership as the only path to retirement. But his unrecoverable cost audit showed that owning would cost him $1,200 more per month than renting. By rejecting the shame and choosing to rent, he is now funneling that $1,200 into a Roth IRA and a brokerage account. He isn't homeless. He is asset heavy. He is building a portable fortress of wealth that doesn't require a new roof every 15 years. We have exposed 3 critical mechanics today. 1. The price to rent ratio is currently flashing red, proving that renting is mathematically superior in most US markets. 2. The opportunity cost of locking capital in a home during a 25% market rally is a wealth destroyer. And 3. The rent is throwing money away. Slogan is a marketing lie designed to hide the unrecoverable costs of homeownership. Tonight, I want you to find one number. The total interest you would pay in year 1 of a mortgage on your dream home. Compare that single number to your annual rent. That is your reality check. Within 30 days, automate the difference between your rent and that theoretical mortgage payment into an investment account. Make the system pay you. If you are done being a source of passive income for the banking cartel, subscribe. Next week, we are going to dismantle the good debt myth and show you why your credit score is actually a measure of your profitability to them, not your financial health. Join the resistance against algorithmic extraction. This video is for educational purposes only, not personal financial advice. All data is from NAR, Zillow, S&P Global, and the Federal Reserve as of December 2024. Products mentioned are examples, not recommendations. Consult a licensed financial advisor for your specific situation.